Welcome to Opalesque. I am in Singapore together with Steve Diggle, who is one of the co-founders of Artradis. Artradis is one of the few homegrown Asian multi-billion hedge funds. It's actually one of the largest Asian hedge funds. And Steve, what is your personal history? How did you get started in hedge funds and how did you set up Artradis?
I first started in finance in 1986. As a graduate trainee out of Oxford University, I joined Shearson Lehman, as it was then. After the graduate training program, I decided that what I was really interested in was to go into the derivative industry. In those days, it was called options and futures, but that's what it became. It was interesting to me because it was, in the late 80s, this was a real frontier of finance. It was a completely new way of approaching risk and risk measurement and risk allocation, and it was mostly staffed with young people, and I found the maths intriguing, and I've really remained in derivatives pretty much ever since. 2001 I was working for Lehman in London, and an old friend and colleague of mine, Richard Magides, who I'd co-run the Barings derivative business with in Hong Kong in the early 90s, said he was going to set up a hedge fund. We talked about partnering in the past, and I thought it was a good time to do it. So by Christmas 2001, we'd established Artradis, and we set up our first fund, which was the Barracuda Fund, in May of 2002. When we did that, the Asian hedge fund industry was pretty much still in its infancy. And the other thing that we really noticed was that all of the biggest Asian hedge funds were either based in London or in New York. There were very few domestic hedge funds in Asia at the time.
That changed at some point, right?
Yeah, it changed organically. I think it became increasingly clear to people that the best place to run an Asian hedge fund from was Asia. That might sound axiomatic and straightforward now, but it certainly wasn't at the time. And it was also very difficult to raise capital because the whole process by which you raised capital was still very much run out of London and Switzerland and New York. All of us here in Asia really felt we were somewhat off the beaten track. There was a small domestic industry in Japan, but really, very few others. Just a few dozen.
And how did that change, that perception and the
I think it's been a gradual process. Clearly, the markets here have developed enormously. The range and depth of the hedge fund industry, everything from administrators, prime brokers, to the managers themselves, and funds of funds and hedge fund investors have gradually developed over the 8 years we've been running things. I don't suppose there was ever really a critical tipping point. But if you wanted to see the milestones along the way, in 2005, 2006, we started to see big multinational hedge funds start to establish offices in Asia, either Hong Kong or Singapore usually. A couple of people even down in Australia. And that process has just carried on. So now we have a genuine Asian hedge fund world. It's debatable how many of us there are, maybe as many as 800 hedge funds operating in Asia, pretty much in 3 or 4 cities. The night desks and the idea that you can run a hedge fund out of either New York or London, to trade Asia is considered, unusual now. There are still some people who do it, but clearly, if you want to have access to information, if you want to trade actively in real time, which our strategy involves, you have to be here.
Tell us more about the Barracuda Fund and then subsequently the other funds.
We launched that in May of 2002. It was our first fund, and for 3 years it was our only fund. The essential idea behind what we were trying to achieve, which was Richard and I had really been in the Asian derivative business from its birth. Asian derivatives hadn't been around for very long. Markets here had a lot of barriers which made actively trading them difficult. There had been a warrant market in Japan very famously during the bubble years in the 80s. Richard had been a Japanese warrant trader when I first met him. But really other derivatives only came along later. And we felt we had a good background in both the derivative industry and its application in Asia, because that's critically important. There are a lot of idiosyncrasies in Asia which we'd grown up with in our 15 years in the region. And the idea was to have a fund that was balanced between two essential strategies. On the one hand, being long volatility, and that's become, in many ways, the defining characteristic of Artradis, which is a long volatility bias. And in times of stress, that has worked incredibly well. And Asia's had a long history of periodic crises. They seem to come along every 4 years, and in the years we've been here, ever since '87, we've had a series, just a series of crises. '97 got a lot of attention, but 2001 was very bad as well when the dot-com bubble burst, or in 2000, I should say, and then we had the SARS crisis, and then last year was obviously a very significant crisis. So the long volatility aspect, and we don't care how we buy volatility. We buy convertibles, we'll buy warrants, we'll buy options, we'll buy variance swaps. We really don't mind as long as we think it represents good value. The problem with that is that when markets are quiet, you burn option premium, theta as it's called in the industry. You've got to find something to fill that gap because hedge fund investors don't like losing money, nor do most people. So we focused on the other side of our proprietary trading experience, which was arbitrage trading. And although that is a phrase that has many different meanings to a lot of different people, when we mean arbitrage, we mean real arbitrage. So closely associated entities, whether it's dual listed stock, whether it's an ADR versus the ordinary, where it's a preferred share versus its ordinary share, a warrant versus the underlying, an index future versus the constituents, convertible bond arbitrage, multiple strategy arbitrage. In most markets in Asia, you can not rely on, but you can be confident that the underlying inefficiencies in Asia will give you arbitrage opportunities. And for 7 years, we've been able to produce profits in the Barracuda Fund, either from our arbitrage profits being greater than our option losses in quiet markets, or our option losses being very significantly bigger than our arbitrage losses when markets become chaotic. And 2007 and 2008 were easily the best years for the Barracuda Fund. We'd gone through some tough times before then when we were making very little money because for at least the first 3 years we were running the fund, options got cheaper and cheaper. It was the great bear market for volatility. There was this great belief that in the what was called the Great Moderation, which now seems rather ironic given how it all ended, but there was a firm belief in parts of the industry that due to superior risk management and abundant savings, we wouldn't have financial crises again. And by the summer of 2005, options everywhere in the world had reached prices which people had never seen before. The VIX had got under 10, that had never been seen before. And you could buy options in Asia for prices which were literally the lowest ever. Very fortuitously, we launched our second fund during the summer of 2005, which was the AB2 fund. And the reason it was called AB2 was that it was Artradis Barracuda times 2, in that we doubled up our volatility bet. And that was seeded by two family offices who'd been invested with us really from the start. In fact, one of them was literally one of our first investors. When we started the Barracuda Fund, we only had $4.5 million, which was our money, and just two investors. But we started AB2 with $30 million, and it literally marked the all-time low of volatility. And that fund went on to become, in some ways, our most successful fund, because in 2007, we made 57%, and last year in 2008, we made 35% in that fund, almost entirely from the size of this long volatility bet.